and welcome. At a time when markets are at a high and valuations are stretched, where's the real value? Today, we speak with Meenakshi Dawar, fund manager at Nippon India Mutual Fund, on how she's navigating these markets and spotting value stocks for her funds at the fund house. So, welcome, Meenakshi.
Thank you very much, Ruchira, for having me on your show.
Great to have you here with us. Let's start with the markets. So, Indian equities, they've been moving sideways lately. Do you see this as a pause in the rally or a sign that post COVID bull run is behind us?
So definitely this is a consolidation phase for the market. Post COVID, we saw a very good growth in the Indian markets. That was driven a lot by what was happening domestically and globally also. So were in a phase of a very large monetary and fiscal stimulus, which was there domestically and also globally, which led to very above normal growth rates in a lot of pockets of the market. But if you see in last 1.5 years, there is definitely a bit of consolidation. So we our growth rates are lower than what historical growth rates we have been, and because valuations were quite high as a starting point, so there is some bit of time correction that is happening in the market, and also some bit of growth normalization that we are seeing in the market. But if I have to give you a view going forward, last 1.5 years, there are a lot of things that happen in the market domestically and globally, right? So there were a lot of global uncertainties. We saw these tariff wars, which market were not prepared of. And domestically also, we saw a phase where we started with some bit of regulatory tightness, and then there was elections, which led to some bit of Capex pushback, which was the theme post-COVID. So all these factors led to some bit of disappointment in terms of what market was expecting in terms of growth rate, and therefore some bit of correction in valuations also.
So, Meenakshi, with valuation turning expensive in certain segments and slowdown in earnings, what's your overall assessment of the risk, market risk, and the opportunity at this point of time?
So definitely, the opportunity that exists in the market right now is the hope that second half year will see recovery in lot of segments which are subdued. So we are seeing some bit of government capex coming back, and government has also accelerated on path of pushing growth, right? So we have seen some amount of stimulus that is being given by the government. We have seen rate cut cycle that has started, and also to boost consumption, government has taken many steps. So we have seen tax cuts which have been announced by the government. So all these things point to a buoyant second half. Now the risk is that whatever we are trying to push on growth by measures of these stimulus doesn't materialize in second half. So if the growth rate in second half is also subdued, and the risk sentiments doesn't improve from here on, I'm talking about business risk sentiments, that's a risk to the market.
And are there any value pockets in this market that you're excited about today?
See, because market has consolidated on a good period of time, last 3 4 quarters. So there are certain pockets where markets is quite disappointed with what has happened in short term, and therefore valuation or value has emerged in these pockets. So those can be, for example, in consumer durable space, there has been a very poor growth in last 3 4 years. The growth has been lower than the trend growth rate, and the multiples are below what the normalized multiple for these sectors is. So if growth picks up and consumer demand comes back post festive, if these companies go back to the normal growth rate, you will see again valuation re-rating that can happen in these stocks. And the other segments where we think that market is extrapolating what has happened in short term, and therefore the value has emerged in this, is the power value chain. So market was very very positive in this power value chain a year, 1.5 years ago, because we were running at peak deficit. But because in the short term, how the weather has played, where summer has been very very benign, therefore the power demand is also impacted. Because of that, there is a lot of sell off that has happened in the whole value chain. So there we think on a longer term structural basis, India will see that 5-7% power demand growth that is structural in nature. And once power demand comes back, you will again see some bit of re-rating that can happen in these stocks, because long term story of India power demand addition, changing from conventional to renewable, etc., are intact, and these are longer term themes.
So Meenakshi, basically there are only two sectors which are you finding value as of now: consumption and power sector.
Correct. So these are two themes where we immediately see, but in on stock specific, we are seeing, because liquidity got impacted, there were a lot of tactical sell-offs that happened in the market. So there are certain stocks within every sector where we see that the valuations are lower than what the potential growth rate of these companies is.
Now, Meenakshi, could you walk us through your investment framework, the principle that guides your stock selection and the sector calls?
Yeah, so sector call is a very top-down process for us, right? So when we take a call on sector, we evaluate that what is the long-term potential of the sector. So if the sector is an inflection point, and last 3-4 years have been very challenging for the sector, but now we are seeing growth turnaround happening in the sector, we are very positive on that sector. Or any sector where we see that there is strong compounding that can happen in Indian market over a longer period of time, we are quite positive on those sectors. So for example, every sector is cyclical, right? Every stock in a sector is cyclical. So consumption, for example, a theme in India can be structural, but like what we saw in last 3-4 years, the growth can be a bit cyclical, and on top of it, stocks can be all the more cyclical because they try to price in certain amount of growth. If that growth doesn't come up, their PE re-rating or derating is quite high. So that's a view how we take on sector. So we focus on what is the long term growth rate potential of the sector, and if that is trading below and we see those inflection points coming in the sector, we are quite positive on it. Whereas stock selection is a very bottoms up ideas for us. So there, personally, I segment it into two pockets. So one is the you want to play certain compounding stories in the sector. So these companies will be typically your market leaders in the sector, right? Companies who have strong managements, who have strong control on their capital allocations, ROEs are good, and over a longer period of time they will keep becoming bigger and bigger in the sector. But at the same time, you want to play certain stories which are very undervalued stories in the sector, because these companies have not done well. Typically when the sector goes through a bad phase, the companies which are at the bottom goes through a severe stress, right? So their balance sheets deteriorate, their P&L deteriorates, their profitability is at all time low. So any company which is reviving, because the whole sector is reviving and there is lot of operating leverage and financial leverage to play in that sector, that is what we go very selective and we go very bottoms and pick up names from this bucket as well.
Okay, now can you share with us how do you determine whether a stock is undervalued? Is there any framework or metric that you follow, and what is the process in general for identifying such stocks?
See, one matrix which comes quite handy in identifying these value stocks is focus on the cash flow generation potential of these companies, right? So, if a company in a bad phase is also able to generate significant amount of cash flows, that's a first screening criteria. That there exists longevity of this particular company, because there is base level of cash flow that exists in this company. Now whenever you have to identify value stocks, you are not taking valuation risk, right? Because these companies you're already buying which are lower on that valuation bucket. The greater amount of focus therefore has to be on identifying the business risk. Okay, because you have already taken care of the valuation risk. Now in business risk, the key thing that we identify is that it should not be a case that this company forever is going to generate poor cash flows, or this company's business fundamentals is going to deteriorate going forward because of the environment that it is in. So if we get comfort on the business risk that this is a temporary phase that company is going through, and as and when cycle turns, as and when business fundamentals turns for these company, the growth will also turn for this company. When we get that comfort, strong comfort on the business of the company, is when we take that call whether this fits beautifully into our valuation framework or value framework or not.
So, but Meenakshi, what is exactly value buying according to you? If you are looking for the stock which is not as growing as of now, but the cash they are generating the cash. So, what's exactly when do you enter this kind of stocks?
So, like I said, you enter these stocks when you realize that there is no valuation risk, right? So, these companies, for example, are already trading at a valuation which is maybe two standard deviation below the market multiples that are it is in. Now, the call is when the business turns. Sometimes, the big mistakes in this whole philosophy of value investing is getting into those so-called value traps, right? You identify a company, you think the valuation framework is in your favor, but the business framework doesn't turn as favorable as you would have anticipated it to be. So we avoid those value traps. The only thing that you have to avoid while doing value investing is to identify that this company doesn't turn out to be a value trap. And how do you do that? Is by taking a stronger call on the business potential of the company. So if this business fundamentals have deteriorated because of temporarily what is happening around, these companies will come back as and when growth comes back. So to give you an example, like maybe during COVID, a lot of these infrastructure companies, capex related companies, had seen a long period of low growth. So therefore, their valuations were what they were have been trading in 10-year average or below those 10-year averages. Now the call we had to take is whether these companies will come back in terms of businesses, in terms of their growth, or these are going to be forever drag on in terms of growth. So if you believe that India will require, or these sectors will be the core sectors and they will come back in the growth trajectory sooner or later, you buy those stocks at your valuation and then wait for the cycle to turn.
The next question was on this value trap, which often disguised as the value potential. So, any other particular thing which distinguish between both of the value traps as well as the solid value buys, apart from the what when you mentioned?
Yeah, so like I said, the thing to avoid value trap is that you have to understand the longevity of the company. If the company survives when the cycle turn, you will make money. But if the company doesn't survive or becomes very low in the whole pecking order within the sector, it will remain value trap for you. So how do you identify that? That in the period of stress also, the company has maintained its balance sheet. So that's number one, that to identify the longevity, that there should be enough amount of cash flow to sustain the business, and the leverage should not be as high that if the stress lasts for longer than what the company had anticipated, that company has become insolvent. So balance sheet risk you have to identify. The second thing that you have to identify is that in terms of within the sector, is the company able to maintain its relevance in terms of market share, in terms of how the managements run the business, in terms of capital efficiency of the business, etc. All these factors are being taken care of. So if you're able to take a call on the longevity that yes, this company will survive, this business will survive, you will make money. But if there is some amount of balance sheet risk that comes into the company, or the company gets into some kind of businesses that take away its cash flows, and therefore the longevity of the company becomes a question mark, that is when typically you have these value traps.
But Meenakshi, do you see this kind of all these factors coming into the small cap and the mid cap side, or is it largely devoted to the large cap side only?
In fact, the risk of business is lower in large caps because these companies in stressed times also have access to capital. right? The whole question, Chirag, is to identify the longevity of the business. If a company is a large cap company and it has a history of business, it has seen multiple cycles, it will survive because it will be in stressful time. Also, it will be able to raise capital or do some asset sales and manage its balance sheet and survive. The stress comes mostly in the small and mid caps, where when the sector goes down, these companies are not able to come out of it because they have not maintained certain amount of balance sheet discipline and P&L discipline, and then therefore they do not have access to external capital as well. But there are certain sectors, like in India also, right? We have seen certain sectors which become irrelevant over time. Like, to give you an example, in media, or we have seen that kind of changes that has happened, right? In terms of broadcasting, like for example, DTH companies. At any value that you would have bought those companies, they would have become a value trap because the business itself was shifting. So their business itself was not relevant 5 years, 6 years down the line.
But the idea of what constitutes low valuation, it keeps shifting with the market. So, how has that changed your approach to investing over the years?
So that's a very fair point. You cannot say that what multiples India was getting maybe 10 years, 15 years ago is the kind of same multiples you can get in companies right now. That's really not possible at this point of time. Why? Because two, three things. That one is that the ROE profile or the balance sheet strengths of the companies itself has changed. So if you look at the ROE generation of the companies right now versus what it used to be 15 years, 20 years earlier, it is very different. The leverage is very different on books. So, and also, in India, because tactically this liquidity profile of the market has also changed, right? Because we were so much dependent on external FII flows maybe 15 years, 20 years ago, which we are not currently. We have significant pool of domestic liquidity available. So we do not see, therefore, companies going into the stress valuations as what we used to 15, 20 years ago. So we will have to give some benefit to whatever structural changes that has happened in the market, and therefore maybe not expect that at these point of times and the way the market are structured today, that we will see those bankruptcy kind of valuations that time and again used to emerge in the market. But the valuation framework that you will use will be the same, right? That you have to see what is the potential cash flow generation of the company, and whether the current market cap is discounting those cash flows correctly or not. If there is a gap in terms of what market believes in the growth rate potential of the company versus what your belief is, you will always get those valuation arbitrages to play in the market.
So Meenakshi, we spoke about how you buy the value stocks and what are your framework. So once a value stock begins to re-rate, how do you exit? How do you decide when to exit? Do you sell a stock based on the intrinsic value or stay if the fundamental is improving?
So, Chirag, that's a very relevant question for a value investor, because once you buy a company, if you keep selling it at the time where you think that everything is, what you believed has been there in the market, and do not ride on the inefficiencies of the market, maybe you will never make those supernormal returns, right? So to make those supernormal returns, for me, the thing that has worked is you keep riding on to those stock till you see business fundamentals deteriorating. So if you bought the company at the right time, and you're riding it, and the business fundamentals are improving after every passing years, which can be growth rate, which can be your delta in ROE, which can be your delta in cash flows, as long as they are in on the improving trajectory, you just hold on to your winners and don't sell them. But when you see those business deteriorate, starting to deteriorate, that is when you decide to sell on to those names.
So you completely stand from value to growth, and then only you exit the stock. It's in a same.
Correct. Yeah, correct. So we do not have a hard exit that, if a stock reaches the market PE multiple, or, if it is at one standard deviation above its own multiple, that you will sell it. But if its business fundamentals are improving, you see that the growth trajectory is in place, market is still upgrading its estimates, you will keep riding on to those names.
Okay. In fact, the cover story of Wealth Inside July edition, it also explores low PE stocks with re-rating potential. So, do you think that's a sound strategy? This approach is sound, or what are the common pitfalls
No,
there?
this is a brilliant thought. In fact, most of the multi-baggers in the market are made this way, that you identify a company which is low on valuation, and then the valuation re-rating happen along with earning compounding. So that's when you make supernormal return on your investments. Now, the only fallacy to this whole argument is that you buy a low PE stock, right? And you wait for its re-rating to happen, and but re-rating doesn't happen because of maybe business fundamentals have not played into what you thought, or the company did not exist 5 years 6 years later. See, you will get a company at low PE only because there is a doubt in terms of longevity of its business,
Hmm.
so you lose money. And then, but the bigger risk to an investor is loss in the opportunity cost. So you invest in a low PE stock, and that low PE stock doesn't go anywhere, but there are these certain levels of PE, which are, maybe median PE stock or high PE stock, but their earning compounding is significantly higher. So they keep compounding at 15-20% year on year, and for 2-3 years they keep compounding, but your low PE stock doesn't turn. So the gap that you have to cover is that 60-70% of earning that you have to cover. So that becomes very difficult.
Meenakshi, what are the key qualitative checks you run to ensure that the growth assumptions behind the re-rating thesis are solid?
So qualitative matrices that you have to run is that you have to align your thoughts with the vision of the company, right? So you need to have a very, very strong comfort in terms of the management of the company, so that the management has a clearly laid out path in terms of their business objective, and they have a plan in terms of how they are going to execute it, and how they are going to get back on that growth path. So that becomes very critical. You have to understand from the whole ecosystem, that which can be its vendors, which can be, it can be suppliers, by the whole ecosystem, and then that company is doing everything possible in their control to get onto the path of growth. So that those qualitative checks in the whole ecosystem is very, very critical for us to understand that this companies, when the sector revive, is prepared to capture on the potential growth.
Right now, let's move on to your funds. So, the performance of Nippon India Flexi Cap Fund, it has been mixed in recent quarters. So, can you share with us what's weighed on it and what are you doing to improve the performance now?
Yeah, Ruchira, so when you do invest in equities, you take a longer term view on sectors and on stocks. So, like what had happened in this fund also, we have taken few sectors calls, few stock calls, which have done with a 3 years, 5 years perspective in mind. Now, last year was a year of lot of readjustments. Like I was saying in the beginning also, that we were on a path of those government capex being way higher than what it has been traditionally, and there was a pause in the government capex itself. So, lot of sectors, lot of companies which are associated with that pocket of the market took a hit. But if you see right now, because that was a short term phenomena because of elections, because of some bit of fiscal consolidation, but there are some sectors, some pockets which are coming back again. So if you look at last few months data, the government capex is picking up steam, and we are seeing that capex activity is picking up on ground. So we were quite overweight, we remain quite overweight, like I was saying, in value, in power value chain. We believe that this is a structural story, and these are just short term blips that has happened because of readjustments that were happening last year, and we are very, very confident that in when the time passes in next 2-3 quarters, things will normalize.
Meenakshi, you rightly spoke about how do you define value, but are there any stocks in the value fund that you wouldn't include in your flexi cap fund, even though you can invest in varieties of market caps?
Correct. So, see, how one this fund will differentiate from that fund is maybe the weightage of stocks which are present there. Like I was saying that in maybe in value fund you will identify certain sectors and you will invest in the whole value chain and stay invested for a longer period of time. But in flexi cap fund we want to play a lot of compounding stories also. So maybe there is not much deviation in terms of what market believes is the right value, right valuation to pay for this company versus what we believe. The difference is that at what, till what period of time and at what rate that these companies can compound. To just to clarify, just to explain my point a bit, like for example EMS companies, right? Now this is a sector which is a high growth sector. Now since the time that sector companies have got listed, these companies have been trading at a higher multiple. But you know that these companies compounding growth rate can be significantly higher than the market growth rate which is there. So you will invest in these companies because you are playing that compounding and you are playing that longevity of growth rate. So in FlexiCap will be far more diversified in terms of these parameters, in terms of these things that we would playing versus the value fund.
Right. And like we were discussing that the value fund, significant mid and small cap allocation to the value fund around 30-40%. So do you have any internal guardrails to manage risk within this segment? Like you were saying that these are more riskier segments. So,
No, so the way to manage risk is diversification.
hmm,
Okay, in whenever you are doing any particular style of investing, the way to manage is by having enough number of stocks in your portfolio and not having very very high weight in one particular stock or in one particular theme, because I said you are ahead of the market in investing in these themes. That's why you're getting them cheap, right? So, because you need to have a holding power which has to be far greater than what you will have historically in other stocks, here, therefore, there is far more importance of diversification, that you control your weight and you have at least 4 or 5 themes that you are identifying in the market that these are things. So, even if one theme doesn't work, there are four themes that will compensate for the lack of performance of one theme.
I mean, actually, the equity portion of your aggressive hybrid fund shows around 50% of the portfolio overlap with the flexi cap fund. So, how differently do you manage the aggressive hybrid fund?
So aggressive hybrid fund is for a bit conservative investors, right? So it's a combination of debt and equity investment. Now, the equity portion, which is 75%, there we want to maybe have a higher weight to the companies which are more large cap in nature, which are sector leaders in the sectors that they are operating in. Therefore, the business risks are very little lower, and also the valuation risks are also lower than the amount of risk that we can or we will take in other funds. So the overlap, maybe the themes will be similar, the kind of stocks that we like will be similar, but here we would allocate capital more to companies which have longer period of being in the market. They have stronger managements, they have stronger balance sheets than what we would do in the other funds.
right. Now, one last question. What are your thoughts on the Nippon India Nifty 50 Value 20 Index Fund? How should an investor decide between this passive value strategy and an actively managed fund like the Nippon India Value Fund? And what kind of investor profile suits each approach?
Yeah, so Ruchira, like I said, that's a passive fund, like you clearly mentioned. So that is far more concentrated fund. Okay,
Hmm.
so their number of companies are far lower, and the kind of sector they represent is quite narrow. So they have a very qualitative approach to investing in terms of anchoring it only to the valuation matrix, which is PE. Okay, so in market, the kind of sectors that you will get which are low PE will be more or less commoditized sectors, or maybe financial sectors. So therefore, the weight of those kind of sectors and companies is very high in that fund. So if that sector, those companies don't do well, this fund will massively underperform. But in our value fund, it is an actively managed fund. This PE investing is only one input, is one anchor that we look for when we screen the company. Like I said earlier also, our focus is, if I have to summarize the investing that we do in value, is identify good assets in bad times. So these good assets can be from any sector. So these can be from consumption, which will be a high PE, but compared to its own history, it's at a low PE. Or so you will have far more diversified fund. You will have fund which will invest in all pockets of the market, and therefore the volatility of the return will be lower than what it will be in a passive fund, which will depend only on these two three sectors. Whenever those two three sectors do well, that this fund will do well.
Right. Well, with that, time to wrap up this conversation. Thank you, Meenakshi, for joining in and sharing your insights. Thanks.
Thank you very much, Ruchira. Thank you, Chirag. It was a pleasure talking.
Thank you. Thank
Thank
you.